as Iran fires missiles at Israel. Stocks take a hit. Not surprisingly, very few people are paying attention to the day's economic data. But there is a nugget of something there that may turn out to be more relevant than meets the eye. I'm going to talk about all of that here. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we will, of course, take a look at the market impact of today's developments in the Middle East and attempt to contextualize them a little bit from a market perspective. And then to take a look at what came out from the U.S. economic data front while the markets were so focused on the geopolitics and what that might portend over the next day here as we take a look at still more heavy-duty economic news flow from the U.S. immediately over the next 48 hours. So this is the response today, and this is the sort of latest screenshot that I was able to take of the price action essentially right into the futures settlement period. And what we see here is not surprising, really. The S&P 500, NASDAQ down, bonds up, and so interest rates down along the curve, 10-year down, the 2-year down, gold up, the dollar stronger, so clearly a bit of a haven bid there. Crude oil spiking higher. It was up over 5% at one point. And Bitcoin looking every bit the digital gold and haven that people portended to be. Oh, wait, no, down 3.4% almost amid the risk aversion. And that's after Iran fired, it looks to be close to 200 ballistic missiles at Israel. The Israeli Red Cross reporting after some time that there were no casualties, which is, of course, a good thing, and markets settling off their extremes after that headline coming out. At one point, the S&P was down as much as 1.25%, and the Nasdaq was down 2%. So this is a meaningful improvement here in terms of what the day's price action looked like at the heat of the panic. Not surprisingly, this overtook the markets, but we did get the ISM manufacturing survey while the markets were distracted. And although it seemed to come out in line with expectations, a look under the surface might reveal a little bit more than meets the eye. So what we have here is an outcome unchanged from the prior month, 47.2. That's basically in line with expectations. Some expectations had it squarely as this. Some averages had it a little bit higher at 47.5. But the upshot here is that the manufacturing sector really didn't change significant dynamics. If we look at the headline, it contracted again. This was the sixth consecutive contraction, and the pace didn't really shift one way or another. In fact, we've been kind of anchoring at these levels for a few months here. But then one might look under the surface and see some interesting sort of indications here from some of the early in the business cycle sub-indexes of the data. So consider here, new orders. It still shrank. This is as ever in the logic of PMIs. So 50 and above is growth. Below 50 is contraction. The faster you're going, is the measure of distance. So the further above 50, the faster the growth. The further below 50, the faster the contraction. About the only exception to the way this works here is supplier deliveries index, which when it goes bigger, that means those deliveries are taking longer. In other words, it's inverted in the sense that slower is higher here rather than higher is faster on some of these other indexes because, of course, of the underlying variable. So looking at the specifics, we can see here's the headline, no change from the prior month, and it's a 6-month run here. But again, new orders still contracting, but note at a slower rate. The index on output almost back to growth and a significant jump here from the pace of contraction seen in August. Inventories now falling, having grown robustly in the August series. And this, of course, suggesting that demand uptake might be perking up if inventories are being drawn down. Similar story from that supplier deliveries index. Note, we were basically at standstill. Now deliveries are slowing, which again suggests that maybe there's more demand, just making it a little bit more of a bottleneck kind of situation, at least as relative to the previous month. Also, the price index down for the first time this year, which may, of course, help with the clearing of inventories, help with encouraging demand. If there were a little bit less of a output price pressure story there. So we're seemingly eyeing some green shoots under the surface of this data. So even as the manufacturing sector in September basically holds near levels we've seen for 2 months now, as far as the pace of contraction, the underlying conditions seem to be giving us a little bit of a sense that things could be anchoring a little bit, maybe looking a little bit better, at least in relative terms. It's important to note that for the manufacturing sector, that we didn't see things get worse is notable, if only because August was itself a rebound after July was the worst in a 4-month series of accelerating contraction. So even just at the headline, we can see things are looking like maybe they are off the worst, which was down here, and starting to get a little bit better after all of this damage being done. Now, of course, we look ahead and we see the services sector on the menu, and that is again expected to give us something relatively steady. The expectation 51.5 on that index, which would be basically the third consecutive month at this pace of expansion for what is, of course, the lion's share of the U.S. economy. If manufacturing accounts for something on the order of 20% of the economy, the services sector is closer to 70. So we're looking at easily the center for where economic activity occurs, where employment occurs. This will be a much weightier sort of report for how the economy is doing. But if we look at what's going on the manufacturing side, which tends to be a little bit earlier, tends to be a little bit leading, as opposed to services, there does seem to be perhaps a little bit of a skew in a positive direction, albeit very cautiously at this point, which underscores the dynamics we've been seeing in markets since the Fed issued its rate cut 2 weeks ago now, and the dynamics leading up into that. The story, of course, as we've talked about before on Macro Money, has been one of reflation. So We've been seeing this sort of message from U.S. economic data for a few weeks now. As a matter of fact, if we look at the way that U.S. economic surprises have behaved, so measuring the way that data has performed relative to forecasts, we can see that we started to really deteriorate mid-April, which of course helps to explain how the markets were so loudly pining for Fed stimulus, even as the Fed was resistant at the time, and why we saw the markets build out aggressive rate cut expectations for 2025. We can see that right here. This is mid-April, and we can see the Fed is resistant to cuts, so the outlook for 2024 is fairly anchored. But as the data starts to deteriorate, the markets say, well, you're going to need to cut more. And so since you're resistant now, it'll be next year. So this outlook for 2025, this yellow area starts becoming ever bigger, and the outlook gets more and more dovish. We likewise see that you get this continued push lower, so much so that not only is the data getting softer relative to forecasts and ultimately arrives in line with forecasts by the time we get somewhere into early May, you then see a much more dark story where the data starts to meaningfully underperform. Not surprisingly, of course, in early July is where you get the Fed coming out. Jay Powell begins it with congressional testimony at the start of the month and says, okay, we're ready to cut now. The Fed ultimately doesn't move in July. That's stage setting month, as it were. And then, needless to say, on September 18th, now just about 2 weeks ago, they issue a 50 basis point rate cut. What's happened since all of this is U.S. economic data from about late August has started to improve relative to expectations. And this might be not just because the data itself is getting better, but because the expectations are being retuned. But from our trading vantage point, where volatility is created when reality and speculation don't match, and so investors have to reposition, which of course where volatility comes from. What's most critical is that now we seem to have come back to a setting here where the data has improved such that it is basically squarely on expectations. We've almost come back to zero. If we continue to see this, we're going to start to see a tendency relative toward relative outperformance. All of this sets us up for perhaps a story whereby the U.S. does not quite need all of the rate cuts that are currently baked in. And again, this reflation story seems to make the point loud and clear. The markets are not responding to Fed easing and the forecasting that they offered, essentially endorsing the market's view for 50 basis points more in cuts this year, at least 100 basis points more in cuts next year. They seem to have responded to all of that dovishness by saying, not that this will lift an ailing economy back on its feet, but that it will stoke inflation in an economy that's doing relatively fine. That stimulus dumped on top of an economy that isn't shrinking or grinding to a halt, but actually seems to be growing at a reasonable clip, if unevenly, that all of this will be inflationary. And we can see that in the steepening of the yield curve, the 10 to 2-year yield getting steeper as we get into the Fed easing cycle. Gold as a kind of anti-inflationary foil, that's up at record highs. And of course, the bond market's implied inflation expectations, 5-year break-even, 10-year break-even, significantly higher, and in fact, at the highest level since June. So the markets are clearly signaling here that they think this stimulus is inflationary and more like pouring gasoline on lit embers than it is attempting to restart a fire that's gone out. And so, with that in mind, the current forecast, envisioning 170 basis points in cuts from here through the end of next year, that of course subsumes 50 basis points over the coming Fed meetings in November and December, and then 120 basis points in easing next year, so veering on 5 cuts, that might well be excessive. We just heard earlier this week from Fed Chair Powell, who said, by the way, don't forget, we are looking at two-sided risk. It is not as if we've said our singular focus on inflation before has become a singular focus on employment now. Quite the contrary. The Fed is very clearly signaling they do not need to go quickly on easing. They have not, in their understanding, missed the window and need to catch up. And so what we see here may well be something that readjusts to a less dovish setting. And in fact, here's that Fed cut from mid-September, and we can see since then, we've actually seen a little bit of a drift into a less dovish direction. Now, this need not be bad news for stocks. We, of course, saw at the beginning of the year that as the economy improved and the stock of expected rate cuts diminished from looking at 200 basis points to only 76 before it rebuilt again, stocks were able to go up through a lot of this. Now, there's also, of course, periods when they couldn't. So here, where stocks swoon in April, we get expectations of less easing. There's a clear transition here where we anchor at about 200 basis points, and from December into late January, early February, stocks are pinned in place. So we don't have the perfect narrative here by any stretch of the imagination, but we do see that through this period where stocks are somewhat listless, this is the place where you get that diminishing run in rate cuts being driven by an improvement in economic data from about mid-January into mid-February, and then things stall for a while, nearly 2 months. So looked at in that way, this rally here from about the middle of February onward looks less like something motivated by increasingly improving data and more like a rebalancing to something that's less hysterical than this forecasting. The situation now may well be different, especially since the rate cut cycle has already begun, whereas here it was almost a year away. So a more apt leading signal might be what the markets did when Powell started to signal just this week that the markets may be running away too far. We saw this looking at the S&P 500 here, of course. Starting this week, still stuck underneath the highs from last week at 58.30. The markets do dip, though, and we can see those spike lows on yesterday's candle when Powell talks. And so the markets don't seemingly have a very positive view here of what would happen if the Fed's rate cut tally for next year were to be diluted. Which is to say then, if we have a situation on the service sector index that's going to be at least alike to what we saw in manufacturing and perhaps maybe a little bit better, if what we're seeing here continues, that is, Well, then we might get more of this. And the reason this, of course, becomes a little bit more worrying then is fewer cuts. Now, a key differentiating factor why this is not this, we touched on this a little bit in yesterday's discussion, might be that the pain from rising borrowing costs is yet to hit. This is a chart from The Economist showing that of all of the rate hike cycles since the advent of the modern free floating exchange rate financial system going back to the early 1970s, this rate hike cycle is the only one where companies' interest expenses have not gone up. In fact, they've actually gone down. And that, of course, suggests the pain has been delayed. A lot of companies hoarded cash during COVID while interest rates were very low, and of course, spent very little of it because everything was on lockdown. Those loans have about a 3 to 5 year rollover rate, so they should be rolling over right about now and into next year. That, of course, creates a refinancing cliff, and if rates were to be higher than currently anticipated, that would make digesting such a thing more painful, which is why this downtick that we see on the S&P 500 here, rejected from the high and, of course, significantly lower now, motivated by geopolitics in large part, though it may have been, may well get further legs if the ISM number dilutes Fed rate cut expectations further. The key level in view here, 57.21 on the continuous contract, and of course then 56.65 is the next major swing top, former resistance, now support. Those become critical lines in the sand for what happens next. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may happen thereafter. I'm back on with Chris for Futures Power Hour on Fridays, on with Victor Jones for the Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.